Could they possibly get a preferred rate? Are banks providing preliminary better rates at this point sometimes?
Surprisingly enough, it's actually if you have an insured rate that you get a lower rate. The reason being is because since there's default insurance on the rate and the bank is protected against defaults, then there's less risk. If there's less risk, then they have to charge less of a premium for that rate. So normally speaking, if you do take an insurance like under 20% down, your rate is going to be lower than somebody that does put 20%.
Okay.
However, at the same time, if you put under 20% down, you have to pay the premium that goes with that. So there's also something called an insurable product. How this works is that when somebody puts 20% plus, or even like the sweet spot would be 35% plus, they have something that's called an insurable product where the bank is able to give default insurance on the loan. However, instead of the consumer paying the insurance premium, it's actually the bank paying the insurance premium.
Because of the higher amount of money they put down.
Exactly.
Okay.
So at that point, at 35% down, that's the sweet spot. There has to be a property value of $1 million and less. And normally it's either purchase or mortgage renewal. So if it's a refinance, it doesn't count. But that's one way to lower the mortgage rates.